Hey guys, welcome to Learning Accounting. I'm Jim Abdulkabir, the founder of Learning Accounting, and this particular channel is expected to treat all related accounting issues, especially for professional accountants. So we'll be looking at courses like financial reporting, corporate reporting, or strategic business reporting for all type of exams, be it the ACCA exams or the ICANN exams or other related tertiary education exams like the masters, the postgraduate or the undergraduate issues, all those exams, we'll be looking into them. Now I would like you to watch the video and drop any questions in the comment section, and I'll be here to answer your question for you. So stay tuned and watch the video to the end. Hey guys, today we want to look at IAS 12 income taxes, but I want to streamline this class to deferred taxes. Now when we talk about deferred tax, how does deferred tax comes to light? Now deferred tax comes to light as a result of the difference between the accountant's book and the tax book. Now you know that the accountant book, of course, are guided by some set of principles, while the tax book are also guided by some set of tax laws. The accountant follows the conceptual framework and the relevant IAS or IFRS standard. Like we have said, the tax book follows the tax law. The accountant will allow depreciation as an expense. The tax authority, on the other hand, will disallow depreciation as an expense, but rather give an allowance called capital allowance. The accountant will capitalize intangible assets. The tax authority will write them off immediately they are incurred. The accountant recognizes some gain or loss on disposal. The tax authority recognizes such transactions. The accountant makes provisions. The tax authority do not allow provisions. So the list go on because there's always going to be difference between the accountant book and the tax authority's book. Now you know the accountant book will always end with a value called the carrying value, while the tax authority book will call it the tax written down value or the tax base. Now the difference between the accountant book and the tax book gives us something we call the temporary difference. Now the temporary difference, I'm abbreviating the information here, it's basically the timing difference. And by the time we consider the application of a tax rate on this difference, it gives us a deferred tax. Okay, so deferred tax basically comes as a result of these that we have summarized. Now, deferred tax, of course, is applicable to assets and liabilities. In respect to assets, where the carrying value of an asset is greater than the tax written down value, then we say this gives rise to what we call a taxable temporary difference. And when a tax rate is applicable on this taxable temporary difference, it gives us what we call the deferred tax liability. And the keynote here is to understand that whenever you have taxable, it's definitely going to give rise to a liability. Of course, this implies that you are owing the tax authority. That is why a liability is coming up in the future, whereby you will be paying back on a gradual basis. On the other hand, where the carrying value is less than the tax written down value, in this case, it gives us what we call the deductible temporary difference. Again, application of your tax rate on this give us a deferred tax asset. Of course, as you can see here, when you have a deductible, it gives rise to an asset. So in respect to the asset section of a financial statement, when you have your carrying values greater than the tax written down value, in this case, you perceive that the tax authority is being owed by the customer or by the client or by the organization paying taxes. In that case, a taxable temporary difference comes to light, and application of this tax rate gives rise to the deferred tax liability. On the other hand, for a liability, if the carrying value is also greater than the tax written down value, then this gives rise to the deductible temporary difference. Again, application of the tax rate gives us the deferred tax assets. Of course, we've already said that when you have deductible, you get the assets. While on the other hand, if the carrying value is less than the tax written down value, then this gives rise to a taxable temporary difference. And like I have said, application of the tax rate will give us a deferred tax liabilities. Again, when you hear taxable, you know it's going to give rise to liabilities. So, to just make it colorful, whenever you see this, know that the opposite application affects the liability, which is a guide. So if you know one aspect, you can actually apply to the next. And whenever you come across this as well, for assets, know again that the opposite applies to the liability. So I have to put this diagram here so that you can easily know that once you can apply it on assets, the opposite will always be that for liabilities. Now the deferred tax account, the deferred tax account, we have the opening deferred tax, which we've already said is your temporary difference multiplied by your tax rate, and the closing, we've also said, is your temporary difference multiplied by your tax rate. And the difference, you get a deferred charge or credit. Now this is more like the balancing figure, and we will stop here today. Of course, if you need more details on IAS 12, you could chat us up and we'll give you more insight on what you need to know about IAS 12. So, but the basic aspect of IAS 12 in respect to deferred tax is what we have above, and I believe I must have shed better light on them.
Now that you're done watching the video, I'm sure it was insightful and it was educational. Make sure you subscribe on our YouTube channel and like our videos, and also share these videos with other friends who might likely have the same exam as you. And I'm sure we'll be seeing again in another session. This is Learning Accounting.